Gold is approaching a massive liquidity zone, and smart money is already preparing their next move. My main focus for this explainer is a potential sell setup sitting just above key liquidity. But there's one specific condition we absolutely need to see first. Right now, most retail traders are staring at the completely wrong level. Let me show you where the institutions are actually aiming. 3,985. That's it. That is the exact downside liquidity target we are tracking for today's bearish bias. The market is flashing a massive warning signal, and this exact level is the key to unlocking the entire macro narrative. Looking at the 4-hour chart, price is carving out this relentless string of bearish market structure breaks. It's heavily respecting premium arrays, those historical levels of institutional selling interest, and it's aggressively hunting lower liquidity pools. Retail traders, they're trying to buy this current dip, stepping right into the teeth of institutional distribution.
Let's lay out the exact trading plan right up front. The current bias remains firmly bearish. The primary sell zone is sitting precisely between 40.22 and 40.35, and that expected external liquidity target rests right down at 39.85. You need to see exactly what this outcome looks like before we dig into the institutional footprints behind it. Now take a look at the current 1-hour dealing range. Look closely at this internal buy-side liquidity that's slowly building up. Price is hovering inside the internal discount portion of this immediate range. Sure, we're seeing a minor short covering rally, but literally every push higher is being met with lower volume. This isn't a reversal. It's purely a structural corrective pullback.
So you might be wondering, why are institutions allowing this upward drift happen at all? Well, they're targeting a premium fair value gap. This specific gap, sandwiched between 40.25 and 40.55, is partially open on the 4-hour time frame, and it's acting like an absolute magnet for price retracements. Smart money is just using this localized rally to engineer premium liquidity. They need that to fuel their next major downside expansion. This entirely exposes the dynamic between the higher and lower timeframes. Over on the left, the daily chart shows aggressive downward displacement, just massive long-bodied institutional expansion candles. But on the right, the 1-hour chart shows this slow, creeping, ascending corrective channel playing out during the London session. This is classic institutional liquidity engineering. They're intentionally building up a pool of buy-side liquidity above those minor intraday highs just to bait early retail buyers. What we're actually witnessing here is a systematic liquidation process. The macro narrative is completely dominated by institutional order flow, favoring heavy distribution. Smart money already swept internal buy-side liquidity on the previous pullbacks, and their next draw on price is zeroed in on the unmitigated sell-side liquidity pools resting right below the recent swing lows. They are methodically layering their short orders. So how do we execute this? For our primary sell scenario, we want an entry right between 40.22 and 40.35. This lines up perfectly with an unmitigated 1-hour bearish breaker block that's overlapping that open fair value gap we just talked about. Our hard invalidation stop loss goes at 40.46, just above the structural 1-hour swing high. Taking partials at the 4,000 psychological level, we leave the final take profit resting at 39.85. That gives us a highly favorable risk-to-reward ratio of 1 to 3.5. But here's the catch. We don't just blindly throw limit orders into the market. We operate on a strict if-then execution model. The trigger has to be price driving higher into our 40.22 to 40.35 premium array. The confirmation? We need a distinct sweep of that internal buy-side liquidity, followed immediately by a sharp market structure shift to the downside on the 15-minute time frame. Only then do we take action and enter on the resulting displacement candle. Looking at the 15-minute time frame, let me be crystal clear. Right now, there is absolutely no trade. The smart money confirmation hasn't shown its hand yet. Entering short positions down here in a discount area gives you a terrible risk to reward, and it completely exposes you to a pre-news liquidity spike. We are strictly in a waiting phase. And as professional traders, protecting capital is always job number one. The absolute invalidation level for this setup is a 1-hour candle closing firmly above 40.46. If price closes above that structural swing high, whether it's before or during the news events, the immediate bearish institutional narrative is dead, invalidated. That would signal a shift toward a much deeper daily premium mitigation, and we simply walk away from the short idea entirely. But here's the problem. Where exactly are retail traders getting trapped right this second? This is the scenario most traders are completely ignoring, and it's precisely where smart money is likely engineering today's trap.
The trap is set to spring around two massive high-impact economic catalysts. First, at 7:30 p.m. platform time, we get the highly anticipated U.S. core CPI inflation data. Shortly after, at 9 p.m., Federal Reserve Chairman Warsh is scheduled to testify. Institutions require massive liquidity to fill their block orders, and they literally rely on the extreme volatility from these exact events to execute their true directional moves.
When you look at the economic calendar, it explains why pre-event market behavior is so critical. This slow London session is trapping early breakout sellers, while quietly stacking up stop losses right above them. That high-impact CPI release will serve as the heavy volatility injection they need to induce a rapid displacement.
Compounding this entire technical setup is a seriously complex macroeconomic backdrop. On one side, we have escalating geopolitical tensions in the Strait of Hormuz. The U.S. has reimposed blockades, and recent military strikes and tanker incidents have caused WTI crude oil to spike sharply. This rising, energy-driven inflation is on a direct collision course with the upcoming U.S. CPI data. It's creating massive uncertainty, with the CME FedWatch tool now showing a 51% probability of a Fed rate hike in September. Now, we aren't here to predict the news. Our job is to neutrally track the institutional footprints this news creates on the chart.
Which leads us directly to the mechanics of the trap itself. Rising safe haven demand from those geopolitical tensions could easily cause a sudden, aggressive upward spike in gold as the data hits. This creates a textbook false breakout, a buy-side sweep that triggers retail FOMO buying and knocks out early short sellers. But the moment that liquidity pool is purged and our premium array is capped, smart money will initiate that aggressive downward displacement, leaving retail completely trapped at the highs. Let's do a quick final recap to lock in today's game plan. The higher timeframe bias remains heavily bearish. We must practice patience and wait for a push up into that 40.22 to 40.35 premium entry zone. Our ultimate target is the external sell-side liquidity at 39.85. And remember, risk management is paramount. Maximum risk on this setup should not exceed 1% due to the extreme news volatility we're about to face. If you value this level of institutional-grade market analysis using ICT and smart money concepts, be sure to subscribe to these explainers. And if you'd like to treat alongside these exact setups with professional conditions, you can find the FXTM account link down in the pinned comment. The market leaves footprints every single day. The only real question is, are you ready to adapt your strategy and follow where smart money is actually going?